Good afternoon and welcome to our webinar. Today's webinar is a tax update for professionals. Our presenters are four of Brown Butler's specialist tax directors. We've got Craig Hughes talking about business taxes, Vicky Hughes covering personal tax and private wealth, James Hurst looking at hot topics in the world of VAT, and Paul Clark giving us an insight into the world of tax dispute and resolution. The webinar is scheduled to run for 60 minutes and the presentations will last around 45 minutes. So there'll be plenty of time for questions afterwards. If you've got a question that you'd like to ask, please use the Q&A facility at the bottom of your screen and we will answer as many of these as possible at the end of the webinar. The webinar is being recorded and will be available on our website afterwards at brownbutler.com. To start the presentation, I will hand over to my fellow director, Craig Hughes. Craig, over to you.
Thank you, James, and good afternoon, everybody. So this afternoon, I'm just going to give you a quick update on some topical issues in business taxes. The two areas I'm going to look at are the new super deduction for capital allowances, and then cover off the increase in corporation tax rate from April 2023. So starting off with the super deduction, in summary, it applies to companies only. There's a 130% first-year allowance for general pool assets for expenditure incurred up to the 31st of March 2023. There's a 50% first-year allowance for special rate pool assets for the same period. So special rate pool assets are typically your integral features. Those are the ones you come across more often than not. Now, with this new enhancement, there are, of course, some conditions attached to it. Firstly, the expenditure has to be on new assets. So there are exclusions for used and second-hand assets. It should also be noted that the annual investment allowance, currently £1 million, is still in place and is there until the end of this year, reducing to £200,000 from the 1st of January 2022. And the AIA runs alongside the super deduction, so you can choose which claim you would like to make. Now, a sting in the tail with the super deduction is that on a disposal, you do have a balancing charge. So ordinarily, when you dispose of an asset upon which you've claimed capital allowances, you would reduce the capital allowances pool and that would affect the allowances going forward. But you do have a balancing charge for the super deduction. And I'll go through a couple of examples very shortly just to show how this works in practice. Now, there are some other exclusions. Usual ones as far as first-year allowances are there for cars, long life assets and leased assets. Now, there was, and there still is a little bit, an issue around landlords and parent companies leasing assets intra-group. When the legislation was first announced, a landlord wouldn't have been able to claim the super deduction because they are leasing assets. However, the finance bill, which actually got royal assent last week, now includes a clause at section 8A, which allows landlords and other companies leasing buildings to claim the super deduction on any plant that is embedded in the building. So again, typically that would be your integral features. So there has been some relaxation there. But the other assets which are being leased, if just normal plant is being leased, then there will still be a restriction for the super deduction. So just going into a bit more detail now, I mentioned before the rate is 130% for general pool additions. Now this is adjusted when the corporation tax rate increases to 25% in April 2023. So where you have an accounting period that straddles that date, you essentially prorata the super deduction by looking at the number of days falling prior to the 1st of April 2023 with the number of days falling afterwards. And so an example there, if you've got this December 2023 year end, the super deduction rate would be 107.4% rather than 130%. But remember, the asset itself needs to be acquired before the 31st of March 2023. And again, there's a similar kind of provision for disposals of assets. So where you have an accounting period ending before the 1st of April 2023, you bring in 1.3 times the proceeds to work out your balancing charge. Accounting periods which straddle the 1st of April, you've got a similar allocation of the multiplier. Periods commencing after 1st of April 2023, there's no multiplier there, you simply multiply the proceeds by 1. Looking now at an example of an acquisition, year end for the company is 30th of June 2023, and we acquire qualifying plant for £300,000. So the super deduction rate for that period, you look at the number of days falling prior to 1st of April 2023 and the number of days afterwards. So we have 275 days over 365, number of days falling before April 2023, multiply that by 30%, add 100%, and that gives you the rate of the super deduction. So in this case, on £300,000 of qualifying expenditure, we'd have a super deduction of £367,808, giving an effective rate of 25.13%. Following on from that, then looking at what happens when you dispose of the assets. Here, we're assuming we acquire plant in June 2022 for £500,000, claim the super deduction on that and tax relief. We then sell the plant in the year ended 30th of June 2023. So we have to work out what our multiplier is on the proceeds. Again, we look at the period both pre and post 1st of April 2023 to work out the multiplier. In this case, it'd be 1.226. And so the balancing charge here will be 245,200. The reason for this is so that effectively we're getting very broadly the same effective rate on a disposal as what we're getting on an acquisition of an asset. Moving on now to special rate expenditure. As I mentioned before, this is just a 50% first year allowance rather than 130%. We still get a balancing charge on a disposal of these assets, and it's based on what's called the relevant proportion of disposal value. Now, in most cases, this will simply be 50% of the sale proceeds. Now, for special rate expenditure on disposal, there are no adjustments required for a period straddling the 1st of April 2023. And we're now looking at an example to show how that works in practice. So let's assume we buy some special rate plant in the year ended 31st of March 2022 for £250,000. We claim the first year allowance of 50% and claim tax relief on that. 4 years later, we sell the plant. Now, what we bring in here is on the proceeds, half of the proceeds represent a balancing charge, and the other half of the proceeds go against the special rate pool, and we carry on claiming the 6%, writing down allowance on that reduced special rate pool. One important aspect of the super deduction is the timing of the expenditure. 3rd of March 2021 was budget day, and you can only claim the super deduction for contracts entered into after the 3rd of March 2021. So these provisions disapply the normal provisions in Section 5 of the Capital Allowances Act, whereby an asset is deemed to have been incurred when there is an unconditional obligation to pay, which could be later than the contract date. For the purpose of the super deduction, the contract date is key. And there are some very broad anti-avoidance provisions which cover any type of arrangements that are entered into to try and get around that. As I mentioned before, don't forget the annual investment allowance is still there, still available, runs alongside the super deduction. It is reducing to £200,000 from the 1st of January next year. And just as a reminder, remember the transitional rules where you have accounting periods straddling the 1st of January 2022. So just by way of example here, if we have a March 2022 year end, the way the AIA works is that you get an 800,000 AIA for the whole period by simply time apportioning the £1 million and the £200,000, but only £50,000 of AIA can be claimed for expenditure in the first quarter of 2022, being 3/12 of the new rate of AIA. So the timing of expenditure is critical when you're looking at periods which straddle the 1st of January 2022. Moving on now to the increase in corporation tax. So as announced, the main rate is increasing to 25% from the 1st of April 2023. Small companies rate will still remain at 19%. And then we'll have the main rate from £250,000 of profits, small companies rate up to £50,000 of profits. So we're having to dust down all those old calculations that we did with marginal relief for profits that fall within the two limits there. And the effective rate within that banding is 26.5%. We're also having to go back and remember all the rules around associated companies and close investment holding companies as well. One thing that this will do is mean that the calculation of comparing salary and dividend extraction and incorporation, that will change going forward, because the benefit of taking dividends compared to, say, salary is going to be far more marginal now or from 2023 than what it is at the moment. So it will be a case of looking at each client, each business, and assessing what is the most effective rate overall, bearing in mind the new rate of corporation tax. As a reminder about associated companies, we ignore dormant companies, and we can also ignore what are called passive holding companies. There are some strict conditions around that in terms of what qualifies as a passive holding company. Very broadly, associated, if one company controls the other, or they're both under the control of the same person or persons. And control is from the CTA 2010 definition. So we're looking at voting, share capital, rights, and the winding up. And remember, we do need to include the rights of relatives as well. So typically that's spouses, linear relations, and siblings. Finally, I mentioned about close investment holding companies. Again, we're going to have to remember what these are all about now, because close investment holding companies aren't able to benefit from the small companies rate of corporation tax. So what is a close investment holding company? It's framed in the negative, which isn't particularly helpful in the legislation. So a company is a close investment holding company unless it carries on a trade, it lets land and property commercially, unless it's to a connected person. And again, you look at associates, or it's a holding company of any of the above companies. So a few things to think about there. Certainly the super deduction is one that's giving us a lot of queries at the moment, but also remember to be prepared for the increase in corporation tax rates from April 2023. I'll now hand you over to Vicky, who will pick up on private client and personal tax matters. Thank you.
Thank you, Craig. Hello, afternoon, everybody. I'm going to talk to you about private client matters, predominantly in relation to property, but then I will make some comments at the end to do with what we think may well happen with tax rates in due course. So there have been a variety of property changes over the last few years, and I just thought it'd be useful to summarise these over a few slides, just to check that everybody was aware of where we're up to now. So interest deductions that can be claimed on buy-to-let properties are now restricted to just the basic rate of income tax. If individuals have a property letting business and they've increased the level of the mortgages they have in that business since they first brought those properties within the business, any additional borrowing above the capital value of the property when it was first brought into that letting business is not tax deductible. And that's something which could catch people out and give them a much lower deduction than they were expecting. As well as the standard rental calculations and consideration of allowable deductions, there is the £1,000 property allowance, which needs to be considered as a separate calculation, which could be favourable to some people in certain circumstances. Now, the residence nil rate band applies for inheritance tax purposes on death, and it's a topic that I've covered at several of these professional updates over recent years. This is just a reminder that the rules are very complicated, but where a home passes to direct descendants on death in a qualifying way, the individual limit per deceased person is £175,000, and so that's £350,000 per couple. And that rate is set to continue without increasing until the 5th of April 2026. And as a reminder, not everybody qualifies for this favourable tax relief. Unfortunately, a number of clients won't qualify because it's only individuals with estates below 2 million or married couples with estates below 2.7 million that will qualify for any of this residence nil rate band at all. So moving on to the next slide. In the recent budget, it was confirmed that the capital gains tax annual exemption will remain at £12,300 up to and including the tax year 2025-26. So obviously that is a favourable deduction for clients, but if they're selling a property at a significant gain, they're still likely to have a lot of tax to pay. So if they've ever lived in that property as a home and they've got an appropriate election in place, principal private residence relief could give them a very valid deduction. This is a reminder that elections should always be kept in mind. If clients own a property and are living in rented accommodation, it's easy to overlook the fact that they may well need to elect for the home that they have a legal and equitable interest in to actually be that principal private residence. So for example, if somebody's living the majority of the time in a rented property and they just come home at weekends to the bigger property, on the balance of facts without an election, it could be that the rented property would be treated by the revenue as their main residence. If clients are doing PPR nominations, you also have to bear in mind that if there's a change in the combination of residences, and again, that can in certain circumstances include rental properties here, a new election needs to be made as the original election ceases to have effect. So moving on to the next slide, there have been a variety of changes to principal private residence relief over recent years, in particular since the 6th of April 2020. The final period exemption has now reduced to just 9 months from 18 months, and a number of us will remember when it was 3 years at one stage. There's also been a very big restriction to lettings relief. That's now only available where the property owner was also in occupation in the property at the same time as the person that was renting it. So if we have the situation where people owned a property that they lived in as their home and they then moved out and let it out to somebody else, they'll not get any lettings relief at all. It's done on a cliff edge basis. So the fact that the rules only changed on the 6th of April 2020 doesn't matter. Unless they lived in that property with the person they were renting it to, they won't get any lettings relief. Now that position is different to the situation where you have a lodger living with you in the home, and the concept of a lodger has been on the statute books for I think it's 4 decades and hasn't changed. So it's defined as somebody that lives with you, eats meals with the family and shares your living accommodation throughout with you. But in reality, that's not necessarily going to be something that happens in the modern world. But if you do have a lodger that satisfies those rules, there wouldn't be any restriction to principal private residence relief. And so that's a very different situation from where you share accommodation, but you have specific parts of that accommodation to yourselves. And it's only in the latter case where you share accommodation where you'd look at the restriction of principal private residence and consider whether lettings relief was needed. So moving on to the next slide, there have also been changes to what happens to the amount of principal private residence relief that can be claimed where a property is transferred between 2 different spouses. There used to be differences in this, but they very much simplified the rules. And from the 6th of April 2020, where a property is being transferred between spouses, the recipient spouse should always inherit the history of the other spouse's period of ownership and the use to which that property was put during that time. So effectively, whoever sells the property, the actual reality of the situation is treated as being the history for principal private residence relief. And then this next points on the slide are just a reminder that eligibility for principal private residence relief begins at the date of completion of the property purchase and runs to the date of completion of sale, whereas the capital gain on a property strictly runs from the date of exchange of contracts for purchase to the date of exchange of contracts for sale. And the reason the principal private residence relief dates are different is that there was a recent case, and this up until this clarification of the rules very much hindered a person that had bought a flat off plan and had exchanged on the contracts for a long period before it was actually ready for them to move into. So moving on to look at other aspects. I'm sure all of you that are helping clients prepare tax returns will have come across the requirement to do a UK property return and payment on account within 30 days of completion of a sale of a residential property. This is a significant change to the rules and came into effect on the 6th of April 2020. So this means that clients need to get returns into the revenue in a very short time frame, which can give us a lot of practical difficulties. There are some exemptions to this, and the main one is that if you're already reporting that same capital gain on a self-assessment tax return within that 30-day period, you don't have to do the separate UK property return. Also, if there's no capital gain to report, because it's covered by other reliefs such as principal private residence relief or the annual exemption, you also don't need to do this UK property return. It's also obvious that you need to have accurate and up-to-date records and speak to clients to make sure they're aware of these rules. Otherwise, there could be significant charges applied to your client that are not expected by them. So the capital gains tax on this residential property and these returns includes residential property situated overseas, unless that gain is exempted from tax under the terms of a double tax treaty. Unused losses and annual exemption can be taken into account, and the tax rate is based on a reasonable estimate of the taxable income at the time that return needs to be done. Unfortunately, you can't take account of any unrealised losses. And so if a client's thinking of disposing of two properties, one standing at a loss and one standing at a gain, it would be desirable for tax purposes to crystallise that loss before you've crystallised the gain. So those could be offset on this UK return. There are penalties, as I've said, for late or incorrect returns and interest in late payments. And this is an area where the revenue will be getting lots of money from individuals that are not aware of these rules and are not in regular communication with their advisors. If you're required to do a self-assessment tax return for other reasons anyway, then you, as well as doing this UK tax return, also need to include the details on your self-assessment tax return as well and claim any payment on account you've made. So now that's all been focusing on UK resident individuals, but the rules are even more wide-ranging for non-residents if you have non-resident clients. The non-resident capital gains tax rules have been extended to all types of UK property and not just residential property, which is what we were talking about for UK residents. So for non-UK residents, they've had the residential property rules from 6th of April 2015 and the commercial property rules since the 6th of April 2019. Any non-UK resident individual who has an interest in UK land or property needs to be aware of this deadline because there's no exceptions for a non-resident. Even if there's no tax due or the property is sold at a loss, there's still a requirement to file this non-resident capital gains tax return within 30 days. Now, the practicalities of this 30-day CGT return also need to be taken into account. As I've said, it needs to be done and submitted within 30 days of completion of sale. And again, that's different from the self-assessment dates, which work on dates of exchange. In order to get this return submitted, the client needs to have a government gateway user ID if they don't already have one. And you need to liaise with them to set up a UK property account, and a new separate authorisation needs to be given to grant you access as their agent. Any existing authority you have for self-assessment purposes doesn't apply. As well as these factors, there's obviously lots of information required to be able to calculate the capital gain on that property, and you only have a very tight deadline. That's why you want clients to be telling you that they're thinking of selling a property before it's actually gone on the market, so you can explain to them what information you need and be gathering this in the background along with them completing the sales process. We found that personal representatives have particular difficulties, in particular in obtaining the online payment methods to achieve payment within the 30-day period. This is something that I think the revenue are looking at, but we found that for estates where the estates have disposed of properties, the return has to be submitted and then the revenue have to process it and actually send out the payment information separately. They don't charge interest in such circumstances so long as the payments are made promptly, but it's just another example of difficulties that you need to be aware of. So then finally, in terms of other matters that are non-property related, given the experiences that we've had with COVID-19 over the last 18 months and the enormous amounts of money that's been spent, there will come a time when the Chancellor needs to introduce tax rises to start recouping this money. A lot of people thought that some of those rises might come in more areas in the budget that we had. And the election promises about tax rates were not covering inheritance and capital gains tax rates. It was only the allowances that have been frozen so far. So those are potential areas which could see increases in due course. We have had various reports into inheritance tax and capital gains tax over the last 18 months. And most recently, the Office of Tax Simplification have issued a report into a review of capital gains tax that was issued on the 20th of May, 2021. It's important to remember that what they are commenting on there doesn't necessarily mean that that will come into the statute books, but it is a very interesting document if you haven't already had a look at it, because it does bring out some of the anomalies in the tax treatment of particular people. And some of those you'll see are familiar from the slides that I've mentioned before. Now, finally, a reminder that there is this trust register. So if you've got any trust clients, it's important that if at the current time that if they've had any tax liabilities, that the trust is entered on that register. The amount of trusts that are going to be caught and need to be registered are going to increase dramatically over the coming months, because they're going to be increased to a number of trusts that don't have a tax liability but will still be required to go on there. The revenue software isn't yet up to date and in place to enable this to happen, and they've estimated that they think this will be able to go live from the summer. And so that from the date that it goes live, they're giving people a year to get all of these trusts on there. That's likely to be a topic that I come and talk to you about in due course in future sessions, but I just wanted to make you aware that if you deal with trusts, that's something that is likely to take some time over the next 18 months. Thank you, and I'll pass over to James to talk to you about VAT.
Thanks, Vicky. And in VAT this afternoon, I'm going to get straight into looking at life after Brexit with some observations based on what I've seen with clients. And it's very much, I think that the picture in VAT is still evolving. A lot of clients have held back from trade with Europe to wait for the dust to settle a little bit as to how things will be. Some clients have been very much caught up in the difficulties of trying to import and export in the early days. And everyone's been finding their way. And that also includes EU countries and not just the UK. And so what we've seen is some flexibility from various member states of relaxing their rules, such as around whether you need a fiscal representative if you have a VAT registration in their country. The customs authorities are becoming more used to dealing with the new requirements and so on. And there have been a number of positives. The postponed import VAT accounting regime seems to work quite well, in the sense of if you're an importer in the UK bringing goods in from the EU, you can now account for the VAT within your own VAT return as a reverse charge. Although on a practical level, we're seeing HMRC system is creaking at the seams at times, and there have been delays with issuing import VAT certificates. But clearly there's some complexity for a lot of people in terms of reviewing supply chains and working out whether you need additional VAT registrations in Europe and so on. And there's continuing uncertainty around the VAT rules for Northern Ireland and how the protocol will work. And I think a lot of those key decisions have clearly been put to one side for now. And so, we will see further developments as we go. One area I think where there's a lot still to come is around the VAT on cross-border services. The UK-EU withdrawal agreement focused very much on movements of goods and not on supplies of services. And one example I saw just this week is where there's a Spanish business supplying services to a UK business in relation to the UK business's activities in Spain. A UK analysis says that that supply is subject to VAT on a reverse charge in the UK. The Spanish tax authority, on the other hand, say that that supply is subject to Spanish VAT, which the UK business therefore has to seek to recover. So there is that sort of mismatch between different countries, and I think these issues will continue to develop for a period of time. One thing I wanted to talk about specifically moving on is looking at the new VAT regime for e-commerce that comes in from 1st of July 2021. So 1st of July is a very significant day in Europe, and I don't mean North Macedonia versus Finland at the Euros before you go and check your wall planners. 1st of July is very significant in VAT. It's when the new one-stop shop and import one-stop shops begin. Looking first of all at the new import one-stop shops, we're looking at situations where focusing on businesses in the UK, a GB business is selling low-value consumer goods into the EU. And from 1st of July, all of those movements of small value items, and here we're looking at below 150 euros per consignment, all of those items will be imports into the EU. And that means that VAT is chargeable on those imports. So if you're a GB supplier selling those goods into the EU to consumers, what do you do going forward? Do you have your customer account for the VAT, which might not be a great customer experience? Do you account for that VAT? Or in the alternative, do you sign up to the new import one-stop shop, which means that you have a single VAT registration in the EU and you account for VAT on all of these supplies based on the destination of the goods, and you account for VAT according to where your customer is located. It's an optional regime. It's not compulsory, but it's designed to simplify matters. We're looking in a bit more detail at the import one-stop shop. As I said, you've got a monthly VAT return. It means smoother experience going through customs. You just quote your new VAT number and so on. But one of the key points about it is that you are required, if you're a non-EU business, you're required to appoint an EU intermediary to look after the registration and submit your VAT returns. Now, there have been strong rumours recently that the UK is trying to negotiate with the EU to have special status like Norway has with the EU, whereby Norway's businesses are not required to appoint an EU intermediary, but as yet we haven't seen anything be announced by Hmrc on this. So at the moment, I think 1st of July is very close, and it seems that if you want to be in the one-stop shop from the 1st of July, now is the time to press forward with your VAT registrations. If you have goods that you sell into Europe on consignments on a B2C basis exceeding 150 euros in value, then normal VAT rules apply, which means that either you or your customer has to account for the import VAT, and then probably you as the supplier, if you account for the import VAT, you'll have to have a VAT registration in your customer's country and account for local VAT on that onward supply, which does mean potentially having multiple VAT registrations across Europe where the goods exceed 150 euros. And that, unfortunately, is one of the consequences of leaving the single market. Moving on to the next slide brings out some points about the one-stop shop, which is not to be confused with the import one-stop shop. And the one-stop shop is where you have a business that is established within the EU. And that could mean, potentially, it could also mean a GB business that holds a supply of stock within the EU from which it makes B2C supplies of goods, and also in the case of the one-stop shop of services. And again, it's a similar idea that you have a single VAT registration within the EU through which you account for all of your B2C sales by applying the VAT according to the destination of the goods. Because Northern Ireland has this sort of hybrid status in VAT, whereby Northern Ireland remains part of the UK, but for VAT purposes, it's part of the EU, then in fact, sales made B2C to Northern Ireland can also be accounted for through a one-stop shop registration. And in fact, it is possible to register HMRC, say, through the HMRC portal, which they say will be operational potentially by 1st of July. Another aspect here around B2C sales is that where the B2C sales are made through online marketplaces, then that online marketplace, such as Amazon or eBay typically, is responsible for accounting for the sales VAT. So that's a case where if you're a GB supplier and you sell the goods direct to the customer, but through Amazon who facilitate the sale, then although the actual commercial transaction is between you as supplier and your end consumer, for VAT purposes from 1st of July, there will be a deemed supply by you to Amazon that's zero rated, and then Amazon are responsible for collecting the sales VAT on that transaction. So quite a change really in terms of the VAT accounting. And because of some of this new simplified system that actually in reality seems quite complicated, I think it is paradoxically having the effect potentially of driving some of the smaller suppliers into the arms of the likes of Amazon, and to get them to account for the VAT because life is a lot simpler. And one of the questions that's comes up about this is around the cost, and unfortunately, because you have to appoint, in the case of your own import one-stop shop registration, you have to appoint an EU intermediary, then that can involve things like providing bank guarantees and paying fees to people to look after the VAT for you. Moving on then to my last section here, I wanted to move away from EU VAT and look at some of the things happening within the UK on a topical basis. First of all, it was a brief reminder that around the COVID-19 measures that there are still special reduced rates in hospitality and accommodation. For example, of 5%, that those rates are going up to 12.5% VAT from 1st of October this year. So to be mindful of first of all, the benefit of the low rates of VAT, and also that those will change again. Where businesses deferred their VAT payments last year, the most immediate deadline is 21st of June, i.e. next Monday, to arrange with HMRC to make payments for that deferred VAT. And then also a couple of cases that have come out recently looking at a thorny and perennial issue of holding companies and deal fees. There are some quite well-established principles now that mean that it should normally be possible for a business that's making acquisitions to recover VAT incurred on transaction costs. And that's typically by registering a holding company for VAT and having that holding company make management charges down to its trading subsidiaries. But these cases that have come out recently both show that HMRC keep plugging away at trying to limit the scope of the ability to recover VAT in this area. So the Jupiter Asset Management case, the court held that HMRC were right to issue a direction on valuation and saying in relation to a holding company charging management services to its subsidiaries that the valuation of the services was not based solely on the VAT bearing costs, but also had to factor in the remuneration paid to the executive directors. And in the case of Tower Resources, HMRC were plugging away at this one, saying that where the subsidiaries had not actually paid for services and they'd simply paid through an intercompany loan, that wasn't true payment. Well, in fact, the tribunal found against HMRC on that particular case of Tower, and said that an intercompany loan is a normal commercial arrangement. But it does show that this is still potentially a bit of a minefield of an area. And then finally, I just wanted to flag the rather more prosaic case of Albany Fish Bar, a fish and chip shop that was assessed for suppressing its takings over the years. There was an assessment for about 100,000 and a penalty of 80%, i.e. £80,000, that it was assessed against the director personally. And it makes the point that actually you need to be careful about challenging HMRC, that they've got the basics right, because HMRC were found to have assessed late, and therefore their assessment was invalid. They assessed more than a year after they had evidence on which to base their assessment. They were a month late, and so the assessment was thrown out of court. But then the tribunal looked again at the penalty of 80%, and they said, well, the penalty is based on the tax that's due or payable. Now, in this case, the tax was clearly due because the assessment was correct in principle, but the assessment was not payable because the assessment was raised late. But that meant that the penalty was still due, so the director still had to pay his penalty of £80,000. And so on that happy note, I'll hand you over to Paul for the next part of the session.
Thank you, James. Good afternoon, everybody. I would like to spend the next few minutes covering off two highly topical areas in the arena of tax investigations and inquiries, and as HMRC referred to it increasingly these days, compliance activity. So let's take a look at each of these in turn. Furlough fraud. Furlough is a well-known word now. We'd barely heard of it 18 months ago. It's the Coronavirus Job Retention Scheme, to give it its full title. It was introduced very hurriedly so that businesses could support staff that they would otherwise have found themselves having to lay off given the lockdown in March last year. As a consequence, claims were made and payments were made very quickly to support those businesses with minimal checks involved at that time. And HMRC have, in the months since it was first introduced, identified two main areas that they are now going to focus on. Firstly, the frauds aspect of it, as they see it, which is where, for example, an employer deliberately claims back wages they are not entitled to, that for example, the employee is on furlough but is still working. Maybe the hours have been overstated in the claim, or making claims for individuals who don't actually work for the employer. The other aspect to furlough fraud is not fraud as such, but where there are genuine mistakes or errors. Given that the speed of which this was introduced necessitated businesses to make calculations very quickly on matters that they had previously never had to handle, it would be inevitable that mistakes would be made. And that has indeed been the case. So HMRC expects businesses to actually self-check, to self-report, and to take action to notify HMRC and to rectify the case. Because if they don't, then the penalty regime may well come into play. What are HMRC doing about this furlough fraud and looking at errors? In March this year in the budget, it was announced that they were going to bring in what they call a taxpayer protection task force, specifically designed to look at the recovery of incorrect furlough payments. 1,250 HMRC staff are either being retrained or recruited. And what they're going to look at has been identified in HMRC systems that, from the data they hold so far, between 5 to 10% of claims are either fraudulent or erroneous. And that's by value, not by numbers of claims. So if you bear that in mind, against the staggering amount of money that has already been paid out under furlough, £60 billion, if we take 10% of that as incorrect for either fraudulent or made in error, 6 billion plus related penalties are broadly what HMRC anticipate they will get from this initiative. Even before the Protection Task Force actually starts to come into play, HMRC have a hotline open and they are encouraging people to come forward to notify cases where it is believed there will have been fraudulent claims made, or the likelihood is that there will have been errors. And as if to show how serious they are, including in this part of the world, there have already been a few arrests made for furlough fraud, including one only 2 months ago in Bradford. This case actually involved other aspects as well, such as money laundering, but furlough fraud was a considerable part of it. What should businesses do, therefore? Well, they should review their furlough payments and claims to show that they were soundly based. It isn't enough just for businesses to think, well, we made what we thought was the right claim at the time, and let's just leave it at that. That isn't going to be enough. If errors are found from a self-check, then the question is, should a disclosure be made to HMRC? And the answer will almost certainly be yes, it should. Bear in mind that records should be retained for this type of aspect for 6 years, and there are going to be considerable numbers of cases that will need careful review and a disclosure made. The second area I want to cover, which in part is furlough fraud related, but is actually more wide-ranging, are what we are increasingly starting to see. HMRC call them compliance or prompt letters. The profession call them nudge letters, and that phrase is being used in the professional press more and more now. But what actually are they? They are a very easy step for HMRC to take, because all that they do is they send out a standard letter, which is generated purely and simply from the HMRC's Connect computer system, which identifies a mismatch between the information that HMRC believe they have now been made in possession of when compared to the tax return for that particular client. And that's as basic as the origin of what will create this nudge and prompt letter. They are sent out in a range of different situations, but quite often, if not likely, it will involve one or more overseas assets that a client may hold. Now, that's not to say that those assets in themselves generate income, which should be reported into the UK HMRC. But such are HMRC systems that they will flag that as a distinct possibility, to put it mildly. And that really is a graphic example of where these nudge letters are coming from, particularly with all the information that HMRC are now in possession of following the signing up by the UK HMRC with other tax authorities around the world, which gave rise to the Common Reporting Standard in 2017. And very briefly, what that now does is that enables HMRC to be in receipt of huge amounts of data involving UK taxpayers that previously they could not be supplied with. And it places the onus on the client and the advisor to decide what they're going to do about this nudge letter. What should they do about it? Bearing in mind that this type of letter, when received by the client, is not actually a formal opening of an HMRC inquiry, although it may have the appearance of being so, it isn't actually the opening of an inquiry. However, that's not to say that the client should just ignore the receipt of that letter. The likelihood is that a response will be required, almost certainly by letter. When that initial nudge letter was received by the client, there will have been a certificate attached to it, encouraging the client to sign. The certificate is drafted deliberately, very widely, both in areas that it could cover and also in time duration. There are no specific time periods put in these certificates. The advice will invariably be to the client, do not sign that certificate, but instead, if a response is required, to reply by letter. However, as with all these things, the client should take proper advice. And there we have the end of my session, and it's back to James to chair the Q&A.
Thanks, Paul, and thanks everyone. That was very, very informative. We've got a few questions coming in. If I could just ask you to answer a few of those that have come in whilst we've been talking. First one, Vicky, is for you. On a capital gains tax return for a UK resident, the question has been asked, if there is no CGT liability due owing to the annual exemption covering that potential gain that was there, do you still need to submit a capital gains tax return?
So if there's no capital gains tax to pay because the gain falls within the annual exemption threshold, you wouldn't have to do that 30-day return to the revenue, you'd be fine. And it would only be, I think, if you had a requirement to do a self-assessment tax return that you might have to think that you'd include it on there as usual. So no, if you're a UK resident with residential property that falls within the annual exemption, you're fine.
That's great. Thanks, Vicky. Next one, Craig, is a question for yourself. How are profits taxed for periods which straddle the 1st of April 2023? So this is corporation tax profits.
Yeah, great question. This is when the corporation tax rate increases. So what you would normally do is time apportion those profits into the pre-1 April 2023 impost and apply the respective tax rate to those two periods. So it's normally done on a time apportion basis. If, say, you had a capital gain arising, then you could just allocate that to the specific period in which it related. So as a general rule of thumb, it's time apportioned unless there's a specific transaction.
That's great. Thanks, Craig. Another question for yourself as well. What's the benefit of the super deduction if there's a balancing charge on the sale of the asset?
Yeah, I mean, this is one of the things that came out of the detail of this. Is it actually as super as it's made out to be? I mean, certainly, if the intention was to sell an asset within a relatively short space of time, maybe 3 or 4 years of acquiring it, then it's questionable whether you would actually claim the super deduction. It might be more beneficial, actually, and counterintuitive to claim AIAs instead. It'd be a case of just running the numbers really through a spreadsheet, looking at the present value of that benefit. If the asset is intended to be kept for the longer term, then generally speaking, it will still be worthwhile claiming the super deduction because of the upfront relief that you get.
Thanks, Craig. That's great. A question that's come in for James, putting you on the spot with this one a bit, really. Checking the reduced VAT rate during COVID for takeaways. What the reduced VAT rate is?
Yes, let me think.
Shall I come back round to you on that?
No. The reduced rate is this is on takeaways, is it?
That was the
you
question.
Say? Yeah. So if you're looking at hot takeaway food and drink, then you'd be looking at a reduced VAT rate of 5% at the moment. But there are sort of exceptions, so things like alcohol is always taxed at the full 20%. But certainly catering on the premises is subject to the reduced VAT rate. but also hot takeaway food and drink like coffees and so on. That's at 5% as well, going up to 12.5% from 1st of October.
That's great. Thanks, James. And a question in for Paul as well. You mentioned about the HMRC task force, and it will commence straight away. But we all seen that these sometimes take a while to get off the ground. How quickly do you think that we'll see the HMRC activity on this one really start to take effect?
And there have been over the years a number of campaigns, as HMRC call them, particularly with regard to, for example, a particular industry sector that HMRC are suspicious of. And it has, in those instances, certainly some of them, taken some time for them to actually get their proverbial act together. However, they are serious with this one. They have announced very formally that they are going to go, particularly after the fraud side of furlough fraud activity, very, very hard. And they're going to be looking for prosecutions, coupled with even the more simple error, so to speak, that hasn't been properly checked. It might not be fraud, but it hasn't been followed through by the company. They haven't checked through what their calculations and submissions were. And if they are in turn seen to be less than making an innocent error, they are careless, or worse still, any of this action is deliberate, or worse, then the penalty regime will be applied very, very severely. So in those instances, not only will HMRC be looking to recover the incorrectly paid out furlough payments, but they will be looking for very significant penalties, and they will amount to considerable amounts of money.
Thanks, Paul. Craig, another question that's come in for yourself. It's around the super deduction and how that interacts with hire purchase contracts. So where somebody's buying an asset for a super deduction on an HP contract.
Yeah, so for HP contracts, so long as it's qualifying plant, then it should still qualify for the super deduction. Just thinking about this now, because yes, there was some commentary around it. Yeah, I can come back and clarify that, but I think it does still qualify for the super deduction. But I can come back to, we've got the details of the person who's sent that question in, so I can respond to that separately, just to confirm.
That's great. Thanks, Craig. Well, thanks to everybody for the time today, all the panelists, and thanks to all the attendees as well for joining us for our webinar. We'll be running another one of the tax professional updates in September. Hopefully at that point we'll all be able to get together in person for that. In the meantime, a copy of this presentation will be available on our website at brownbutler.com in the next few days. Thanks again for your time, and thanks for attending. Goodbye now.